Welcome to the Real Estate Show with your real estate and mortgaging team, Terry Kilakos and Merav Marciano on CJAD 800.
Good afternoon, everyone. You're listening to The Real Estate Show. I'm your host, Terry Kilakos, chartered real estate and mortgage broker, as well as president of Northeast, a real estate and mortgage agency, and the Coldwell Banker Commercial Alliance. And today we're going to be talking about literally my favorite subject of all time. Merav, do you know what this subject is?
The beach?
No, that's your favorite subject. For me, it's actually investing in the real estate that surrounds the beach. Whether you're an avid investor or a first-time investor, this is the show for you to actually be listening to. Joining me, that beautiful voice that you guys just heard was my beautiful co-host and partner, Merav Marciano, chartered real estate and mortgage broker and vice president super extraordinaire of Northeast and CBC Alliance. Welcome, Merav.
Thank you.
Feel free to reach out to us online at nordest.ca, and you can also visit us on our Facebook page, which is facebook.com/Northeast Nordest and facebook.com/CBC Alliance Quebec. And if you haven't done so, shame, you need to subscribe to our YouTube channel, which is newsonthego.ca. And, when you watch our shows on there, if you ask any questions, I'll do my best to go in every week and kind of answer people's questions through the comment section over there. So go in, ask your questions, have fun, and watch us break things in the studio, which I tend to do all the time.
And for those who don't want to watch us, you can listen to our podcast on Spotify.
Or iTunes.
Yes.
Exactly. So let's kick it off today. Merav, we're talking about investing in real estate. And for me, real estate has always been a very lucrative place to invest. And I think that it's been a very lucrative place to invest for a lot of people. What are your thoughts on that?
I have to say, I love real estate. It comes obviously with, with pros and cons, just like any investment, just like anything you do in life. Everything comes with a risk. Everything comes with, the good, the bad, and the ugly. And I think there's more good than anything else in real estate. And I personally enjoy it as an investment vehicle.
So I'm going to give you guys a couple of stories because, as you know, I like to hear the sound of my own voice. So I'm gonna tell you guys a couple of fun little things that my mommy told me when I was growing up. So my mom, when I was younger, she ingrained in my brain. I like that. I'm going to actually use that. That's a good rhyme. She ingrained in my brain that you should never buy a single family home until you have enough rent that comes in from other properties that would pay for that single family home. And, my mother literally, she was a seamstress. She worked in a factory, but we owned the building that we lived in. It was a triplex in my land. And it was a great property. And I understood we needed, or back then, because my parents didn't have a lot of money growing up, they needed those rents that were coming in from that building to make sure that we as a family were actually supported. And I actually did the same thing when I ended up turning 24, which a lot of you know. I ended up buying my first property. So at 24 years old, I scoured the city of Montreal, and I ended up finding a building in Hochelaga Maisonneuve, which I paid $107,000 for, which today I still own it, and it's worth significantly more. But the beautiful thing was my tenants actually paid for me to live, which allowed me to save more money and actually grow as an investor. And then a couple of years later, I was able to go in, refinance it, grab some equity, and buy more properties. Right? So when we had met, Merav, although you weren't a fan of the property.
Back in 2001, Hochelaga was not the same, Terry.
I agreed. But you know what? You have to go into developing areas.
Well, I did have to wear a bulletproof jacket.
Oh, come on. No, it wasn't that bad. It really wasn't that bad. And the neighborhood actually during that time was undergoing gentrification. So one of the things that I did when I ended up buying that first building, before I made the decision to actually go and buy in Hochelaga, is I called the city. And it's something that I encourage any real estate investor to do. Pick up the phone, call the city, and say, hey, which neighborhoods are under subvention right now? So subventions are when the city actually gives subsidies to the landlords to do the bricks, to do the windows, to change things up in the property. If the city is investing in a neighborhood, don't you think that it's a good idea for you to invest in that neighborhood as well?
Because that would be a sign that that neighborhood is up and coming, basically.
Exactly.
Okay.
So I thought it was pretty smart. I went in, and sure enough, the minute I bought it, it ended up going up in value, which was really, really good, right? I mean, over time. So
So would you say that now is still a good time to buy real estate? Because some people are really playing the waiting game. Let me wait and see. Let me wait if it goes down. Let me wait.
So my philosophy is always, when you go into a real estate transaction, any type of transaction, whether you're buying a investment property or you're buying a condo or you're buying a home to live in, okay, it's a calculation that you have to do. And I've always said that you have to see the win going into the deal. If you don't see the win, always take a better look at it. So what do I mean by that? A lot of people think that as interest rates go up in the next coming years, we're going to end up seeing house prices drop. And that very well might happen. We might end up seeing a market correction occur. A market correction happens when prices drop by 10%. We might even see a market crash occur, which will show a drop in prices of 20%. But you have to remember something. That drop in prices is not off of today's price. It's off of a future price. Right? So if you're able to secure something now for $500,000 and the crash or the correction happens in 2 years, it's going to be off of the future price of the property. A lot of people don't realize that. And depending on how you go into that property, so for example, if you're buying it and let's say you were paying rent right now, well, if you wait until that correction occurs, you're going to continue paying rent.
That's true.
Right? Which means now you're actually spending money over the next couple of years where you could have gotten in. And even if there's a correction, chances are in a couple of years, you're going to buy it maybe at the same price as what you were going to buy it today. So you might as well take advantage and let your net worth grow earlier.
And honestly, if you're collecting rents from that property, the value of the property is not really affecting you, because as long as the rents are the same amount and you're collecting the same income, if you're not planning on selling that property right now, it could fluctuate up and down a few times over the next 10 years. You won't feel it in your pocket.
So you bring up a really good point. So the building, when I bought it in Hochelaga, everything went on sale in Hochelaga in 2000. Literally, I think on my street, I think the biggest mistake that I did is that I literally didn't buy out the street. Okay, but I didn't know then what I know now. If I would have bought that building in 1999, for example, I probably would have been able to buy the same type of building for anywhere between 60 to 80,000. The minute we went into 2000, the prices went above 100,000. When the prices went above 100,000, everyone started liquidating their properties because they thought that this was the most that the area was going to go up, right? And when I bought it, people literally made fun of me. They were saying, "Oh, you're overpaying for a property. You could have bought this last year for 70,000, 60,000, 80,000." I heard everything. What came out of my pocket to secure that property, to buy it and get a mortgage on it, was $27,500, and that actually included my notary fees. That
was your down payment plus notary fees.
Exactly. Down payment plus notary fees. Plus, I think there was like some tax adjustments and stuff like that. It was $27,500. The rents that were coming in, my profits at the end of the year were 14 and change. I don't remember what the exact number was. So let's assume that that building would have dropped in value from year 2000 to 2001 or 2002. Do I really care?
If you're not planning on selling, no.
No, because also for me, the win was the rents. Right? So I did the calculation. I said, I put $27,500 out of my pocket. I'm making $14,500. That's a return of X per year. It was like 58% return on my money that I was making. Even if the value of the building had dropped to $60,000, $70,000 again, the rents were still coming in because the tenants were still there. And that's all I actually cared about.
Yeah.
Make sense?
Absolutely. I also heard you say often you can be either a rancher or dairy farmer type of investor in real estate. I love that explanation. Can you go over that?
Yeah, so I love to take credit for it, but it's actually Robert Kiyosaki that said that originally, and I kind of copied it. But he basically says, when you invest in real estate, you're one of two types of people. Either you're a dairy farmer or a rancher. And you need to make that distinction in every deal that you go in. You can be a combination of both across your portfolio, but every property you buy needs to be one or the other. So what is a dairy farmer? A dairy farmer is going to buy cattle, and they're going to cows, right? And they're going to milk them and make money off of the milk. And eventually they'll get slaughtered, but for the most part, the money's made from the milk. Exactly. Whereas a rancher is going to buy cattle, raise them, feed them, and then eventually take them to slaughter. So a dairy farmer is akin to someone that buys real estate, holds it, and collects rent. Whereas a rancher is someone that'll buy a property and flip it for profit. So you got to make sure that, every deal that you go into, you're either one or the other.
And would you say this is a market to be a rancher?
The market is going up. So if you're able to secure some good deals on properties, yeah, you can make some money as a rancher. I would actually say in this market, it's probably harder to be a dairy farmer than to be a rancher, just because of the price point that you're getting in on properties versus the rents that are coming in. Make sense?
Yeah, absolutely.
But a rancher, you can find some decent deals, go in, rehab them, and flip them out to for a profit. When we come back, we're going to be looking at the different ways to invest in real estate. But first, we're off to the CJAD Traffic Center.
You're listening to The Real Estate Show with your real estate and mortgaging team, Terry Kilakos and Merav Marciano on CJAD 800.
You're listening to The Real Estate Show, and today we're talking about real estate investments. Feel free to visit us online at nordest.ca, or you can reach us at the office where Olympia is happily standing by to take your calls, 514-680-4674. And yes, she does not sleep. She's always available.
Poor girl. It's Sunday. It's her day off. She's standing by.
Anyways, okay. So let's talk a little bit about, because this is a little bit of a difference that we've had in opinions over the years, and I'm curious to see how your opinion has changed over the years. Okay, so do you feel as a first-time real estate investor, you should actually start small, get your feet wet on a smaller property, or do you think that people should go big?
I think it has to do with your character.
Okay.
So I know certain people who worry a lot and things like that. Going into a, 8-plex might not be a good idea, or who are afraid of the idea of becoming investors. So for me, I do like the idea of going small at first, just because you get to see, do I like the idea of having a tenant? Can I manage fixing things when they break? Can I manage answering the phone at 10 p.m. when there's an emergency? If you can't handle one, how are you going to handle 8? So that's my logic. Now, obviously, we know that, once you start accumulating your down payment, the more down payment you have, the bigger you can go in the amounts and all that. So it all depends on how much of a down payment you have, how much of a risk you're willing to take on that first property, and how comfortable you are with adjusting, learning on the go, and maybe falling on your face a few times.
So my philosophy is, I do agree with you. Okay, so there's a part of me that agrees, and then I look at myself and I say, that first property that I bought was that 4-plex, which already I find that for my age and for the time that I bought it was a big deal. It was a big investment. I mean, we talk about $27,500 right now. Maybe, to some of our listeners, it's not a lot of money listening to it right now. Maybe some of them are saying, oh my God, that's crazy. How did you manage to save up that money? But the point is, for me, at that specific point in time, it was a lot of money. And it was everything that I had and I was able to afford to go into it. So this was, I think at the time was good. Knowing what I know today, what I probably would have done is I would have aligned myself with the right team. And this is important. And we've talked about this before, how having the right team behind you, whether it's a mortgage broker, a banker, a good realtor, good people, electricians, plumbers, everything, I think I probably would have gone bigger if I know what I know today. And I've said in conferences that I speak at, in real estate forums and stuff like that, I've always said that the biggest mistakes is that I didn't go bigger sooner because I didn't know how to.
Yeah.
And I happily admit that mistake. I didn't know how to because I didn't go and seek the right advice from the right people.
Well, that I have to say nowadays is a big problem. Everybody's an expert in everything, and we see it everywhere. Everybody knows everything about everything. So my cousin told me not to invest in this. My brother, my sister's friend is a realtor. My friend's husband works at the bank. So it's really hard to get the right advice if you're just getting advice from the wrong sources. Sometimes it could be the right sources, sometimes it could be the wrong sources, but just make sure you are, I agree, the right team is really, really important.
And you know what? You need to also make sure that, the people that you're getting the information from, besides the fact that they need to be a credible source for that information, but you got to make sure that they're also looking out for your interests and not the interests of what they're trying to represent. Right. I had a client just this week who basically reached out to me and said, look, we have X amount of dollars to invest. We're thinking about buying an investment property. We're not sure if it's the right move for us. Can you help kind of guide us a little bit? So I sat down with them. I analyzed their psychology, if that makes sense. And I said, based on what I see, based on what you guys are telling me, based on your risk profile, I don't think that investing in real estate is the right move for you guys. Mm-hmm. So I was very upfront with him because to me, the most important thing is that my customer is happy. And my customer won't come back to me and say, hey, you did this. Make sense?
Absolutely. Absolutely. And there's also different ways of investing in real estate. We focus on buying and renting out, but when you buy a property, there are different ways of making money from that property.
Yep.
And I think that's important. So we did cover the rents,
which is the cash flow.
The monthly cash flow, that's really important. Obviously, you don't want to be in a negative cash flow situation where you're dishing out money every month from your pocket, unless it's a temporary situation and you plan on renovating and increasing rents or whatever it is. So I think that's really important that you're positive from day one. But then we're talking, what we're seeing right now, passive appreciation.
Exactly. And that's based on the market, right? So based on the market value of the property, the market changes, your property will passively appreciate. Just like my property, when I bought in Hochelaga in 2000, passively appreciated from 107 that I bought it to 160 in like a year. Mm-hmm. That was passive appreciation. And I'm not even factoring that into the calculations.
Yeah, and that's not counting any renovations, anything like that. That's pure market appreciation.
Yeah.
Now you can do active appreciation where you actually say, wait a minute, let me go in there, renovate, add an apartment, add a room, whatever it is that you can go in there and do in order to increase the value of that property thanks to your work, thanks to your sweat equity that you put into that.
Can I give an example of active appreciation here? Again, going back to that property. So when I moved into that little unit, so I took the smallest property, which was a little bachelor. It was literally a kitchen, a living room, and that's it. There was nothing else. And a bathroom. It was a studio, yeah. So I had a fold-out couch. That's where I slept on. And it was okay. Now, the unit that was right next to mine, so there was 2 units on the main floor. It was 2 6.5s. There was a larger, there was a 5.5, and there was my little unit. It was too big for the guy that lived there. And he was actually thinking about downsizing. So I said to him, hold on a second. You want to downsize? What I'm going to do is I'm going to grab one of your bedrooms from your unit, and I'm going to put it into my unit because it was a very easy way. I close one door from one side, I open another one. And just by doing that, now all of a sudden, I had 2 apartments with 2 bedrooms on the first floor. That in itself increased my rent and increased my cash flow and actively appreciated the value of that building. So that was a good example of active appreciation. Make sense?
Yeah, absolutely. I remember that little room.
Yeah.
And I wanted to talk a little bit about principal recapture, whereby you actually get money out of that property.
Yeah.
Which that's where the cherry is on top of that sundae. So maybe you can explain a little bit about that, Terry.
So principal recapture basically means every time you make, let's look at the foundation of it, right? So every time you make a mortgage payment into your property, there's a portion that goes into principal and there's a portion that goes into interest. The portion that goes into interest is money that is out the window, okay? Mm-hmm. The portion that goes into your principal is money that goes into your property and raises your net worth every single month, okay? So when you own the property for 6 months, a year, year and a half, 2 years, whatever, you have a certain amount that accumulates in that principal. So a principal recapture basically means is you're going in, you refinance the property, and you recapture back in cash that amount of money. And there's actually a term for it also, so a lot of people use it, which you like saying all the time.
Brr.
Yeah, which is buy, rehab, rent, refinance, repeat. And you just basically keep doing that over and over and over again. And now all of a sudden your portfolio grows and grows and grows, right?
Yeah, because basically now your down payment for the next investment property comes from the refinance of your
previous one. Exactly.
And you can repeat this over and over if you're doing things properly, obviously.
Yes,
if
100%.
There's appreciation, if you're paying down your mortgage properly, etc.
Yeah. And when we look on the, kind of the commercial and multi-residential side, we talk about net operating income quite a bit. I don't know if you want to go a little bit into that.
Sure. So it would basically be your revenues minus your expenses. And this is a number that you look at when you're looking at investment properties on the commercial side. You don't count your mortgage payments in there because obviously it's variable based on what interest rates you have, etc. So we can look at that definitely after the news.
Okay. So for me personally, even on smaller properties, I go based on the exact same metrics. Anyways, we'll talk about that in a bit. When we come back, we're going to be looking at the pros and cons of short-term rentals. And now we're off to a CTV news update.
You're listening to The Real Estate Show with your real estate and mortgaging team, Terry Kilakos and Merav Marciano on CJAD 800.
You're listening to The Real Estate Show, and today we're talking about how to start investing in real estate. Feel free to call us with your questions at 514-680-4674, or you could visit us online at nordest.ca. And don't forget to subscribe to our YouTube channel, which is
newsonthego.ca.
There you go. So before we went off on to the CTV news update, we were looking at, we were talking about net operating income. I don't know if you want to expand a little bit on it.
Yeah, absolutely. So on the 5 doors and less, you'll see it less in the calculations, but in the 5 plus, on the commercial side, definitely this is an important number, especially when you're applying for financing and when you're...
Sorry, when you say commercial, do you mean commercial like a store, or you mean commercial like multi-unit?
Multi-unit.
Perfect. Okay.
Yeah.
I just wanted to clarify it. Sorry.
You're just testing me. That number is really important, especially if you want to see if it's worth for you to buy a property, and also banks use it a lot to see if what's the return on investment on this property, etc. So it's basically your total revenues minus your expenses,
not including your mortgage.
Not including mortgage payments or taxes, just because those are separate. And basically, you take that number, and based on that number, you also know what's the value of the property. So that's another calculation with cap rates, etc. But I don't want to complicate things.
Okay.
But at the end of the day, the value of the property is based on the net operating income.
Okay, interesting.
So definitely if you're working with the right kind of mortgage broker who's used to doing commercial real estate, if you're working with the right real estate broker who's used to working with commercial real estate, they'll do those calculations with you. If you go to a residential real estate broker,
they don't know how to do the calculations.
Yeah, and it's not their fault. It's something completely different.
It's a different training.
It's a different training, and it's a different animal altogether. It's all math-based versus this is a lovely property, and I could see myself living here.
Look at the rotunda.
But you know what I mean?
Absolutely.
It's a completely different feel. So that's it. So that's with respect to net operating income. It's really, really important to know how to calculate that and to go into a property winning.
One of the things that I've actually noticed lately, when we're talking about smaller multi-unit properties, a lot of the people are not actually following those rules when they're listing the properties because, again, it's the wrong agent that's listing them. And they're basing the values off something that they believe market value. They're looking at future potential revenues, future this, future that, and they're marketing the property or selling the property based on that. And then what we find is that once these properties end up going to the bank, the value is not supported on them.
It all depends what type of property it is. When you're talking about a small multi-unit duplex, triplex, you're looking at...
I'm not talking about that. 5+ doors.
Okay.
Yeah.
Because the smaller units, they're going to look
That's
at
market.
It's comparables.
Yes.
They're going to do a typical, an appraiser will compare what the other duplex sold for. But when it comes to bigger multi-units, it's always based on rents. It's always based on revenues. This is a business you're buying.
Exactly.
And is this business worth the amount you're paying for it? That's really what it is.
Yeah.
You know, you're not buying a structure, you're buying a business. And that's why the comparables to other buildings, you can have 2 10-door buildings side by side. One is worth more than the other because of the rents it's collecting.
Yeah, absolutely. You're becoming like me.
Oh my God, I'm talking with my hands, hitting the mic
So
nonstop.
those of you who have had the misfortune of having an appointment with me, you'll see that I talk with my hands a lot, and I do it in studio, and I knock my mic all the time, and I seem to have rubbed off on Merav because she just did the same thing.
I also wanted to bring up an important subject, and it's a big trend. It's the Airbnb, short-term rental in general.
Yeah.
What do you think of those?
I think it's great. Listen, if you're able to, buy a property, a lot of times we see this either in the downtown core. Well, unfortunately, not so much now with COVID around, but more when you're going in the outskirts where you're buying chalets, you're buying places like that. You can actually make a lot of money Airbnb-ing them. The thing that you have to be really careful is before you decide to buy a property and Airbnb it, does the municipality allow for Airbnbs? And we've seen it in downtown Montreal. Valerie Plante, she put in a moratorium on that. You can't Airbnb your property.
And we'll go even one step further. Some buildings don't allow it.
Yes, very important.
So you do have to follow the rules of the condo association. If they don't allow...
If it's a condo, yeah, absolutely.
if they don't allow for you to do short-term rentals, it's important to follow the rules. And there are a few cons with respect to it. Financing can be a little bit difficult because these are not long-term leases signed. These are short-term. So you definitely have to prove a track record before you can apply for financing and prove that these are your revenues for that. And the other thing that a lot of people don't know, your insurance doesn't always cover if there's certain damages, because that's one of the questions when they
Will
ask
you be doing short-term rentals? Yeah.
Will you be renting it, and will you be doing short-term rentals? It's different premiums if there's going to be 16 different people going through your house during a month rather than just one person.
Yeah.
You know, so definitely it's things to look at before you get into it, but definitely a lucrative business.
I agree. I am, my philosophy, a lot of times people, they want to save that couple of $100 a year on their insurance, so they're not going to admit that they want to do an Airbnb. Guys, this is a property that is worth hundreds of thousands of dollars. Let's be real here. Pay your extra couple of $100 in premium annually, and you're going to be good to go. And you don't have to worry about anything.
I agree.
Sometimes, and I'm going to say it in Greek.
God.
You ready? Taftinata pramata tatrone ikotes. Directly translated, Marco is looking at me like, what are you talking about? Which basically means cheap things are eaten by the chickens. Okay? So when you try and be cheap on something, it doesn't work out. It ends up
God,
chicken feed. Sorry, I had to say it. Yet another wise words from my mother.
Now let's talk money. How do you get the money for the down payment if you don't have it all? You have ideas, Terry?
Look, you can, obviously, if you have other properties, the easier and, the path of least resistance is to go in, you refinance, you grab equity out of the properties, and you could use that to buy other properties. And when you do that, even if you have a principal residence that you want to refinance, grab money out to buy something, that portion that you grabbed out of that property, because it's being used for investment purposes, becomes tax deductible. So it's great, okay? And then, oddly enough, you're buying the property at 100% financed, theoretically, right? You can also, get gifts from family. Obviously, when you're buying properties, you can use RSPs if you're going to be living in the property. So let's say you buy a multi-unit, and a lot of people don't realize it. So let's say you want to buy a fourplex. You're going to live in one of them. Nothing stops you from using the money out of your RSP. Actually, because you're living in it, you're allowed. You can even buy a 5, a 6, a 7, an 8 unit. Up to $35,000 can come from that. And you can also use lines of credit. There's a lot of different ways that you can get it.
I think a lot of people don't know that you can. They think it's only for a single family home or duplex, but it's very interesting that you can use your RSPs as first-time home buyer, even
Absolutely.
for a multi-unit.
Yeah,
it's interesting.
Provided you are a first-time home buyer and you're living in it.
Of course.
Very, very important.
And they do verify that, by
Yes.
the way. We've had people tell us they do verify that. They'll ask proof that you're living in it. So
that you bought it, that you're living in it. Yeah, absolutely. Yeah.
In the commercial world, multi-residential world, you'll see sometimes balances of sale happen.
Okay.
So sometimes, especially now, if the appraisal comes in below market value, you can sit with the vendor and say, look, I know you really want this amount. The bank came back at this amount. Is there any way you could make up the difference with a balance of sale? So it's basically a loan that the vendor is giving you, which will be attached to the house, of course.
Yeah, and the balance of sale is also called a vendor take-back, depending on where you got your education from. So you can call it a vendor take-back, you can call it a balance of sale. It's basically the same thing.
And last but not least, you can cross-collateralize with another property. That just means you're basically putting a mortgage, you're putting a lien on a different property in order to take out some value to get a mortgage on this property.
Interesting. Like I said, for me, I think that there's a lot of different options. There's a lot of different possibilities with real estate. I've always been a fan. I think I always will be a fan of buying and investing in real estate. Anyways, I'm gonna, till my dying day, I'm gonna be, on a soapbox screaming, buy real estate, people. Up next, we'll have a look at different types of real estate investments out there. But now, we're going to take a small detour off to the CJAD Traffic Center.
The Real Estate Show is brought to you by Northeast Real Estate and Mortgage Agency.
Thanks for tuning in. Today's discussion is about investing in real estate. Don't forget to subscribe to our YouTube channel, which is
newsonthego.ca.
Thank you very much. Okay, so before we went off to the CJAD Traffic Center, we were talking a little bit about, kind of investing in real estate and
where to get the money from. Yeah.
So let's look at the different ways to actually invest in real estate, because a lot of people think that the only way to do it is to buy a property, but there's other ways.
Of course, but let's go first with what types of properties you could invest in.
Go for it.
So you can go residential. First of all, let's go residential.
Okay, so residential properties, single family homes, single condos.
So
right?
Single family home, house, condo.
Not a huge fan of it, by the way, for those that are listening. I'm not.
A lot of people, that's how they started.
Agreed. But the problem is when you have a single family property, when that tenant leaves, don't forget, you're out all the rent that you're collecting.
Absolutely. I agree. You have to be very, very careful not to have vacancies or not to have long vacancies, because that comes out of your pocket 100%.
And it affects your yields and your cash flow at the end of the year.
Absolutely. So definitely we're more fans of 2 units plus.
Yep.
So that at least if you've got that one tenant leaving, you've got the other rent being collected. It might still not cover you fully, but at least it's a very short-term and small negative
expense
cash
out
flow.
of pocket. Yeah,
exactly.
Agreed.
And on the with respect to multi-unit, obviously you can go as big as you want. The bigger you go, if you're talking about 100 doors, one tenant doesn't affect you as much as if you're talking about 5 doors.
Yeah. Actually, let me go through something interesting, because this I should have mentioned this earlier, but let's talk a little bit about the down payments. I just want to connect to that a second. If you're buying a single family home, a condo, or a duplex, and you plan on living in it, the minimum down payment is 5%. If you're planning on having it be purely rental, the minimum down payment is 20%. If you're buying a triplex or a fourplex, the minimum down payment is 10%.
If you plan on living in it.
If you plan on living in it. If you're not living in it, so it's purely speculative, the minimum down payment is 20. Interestingly enough, if you go over 5 doors, so from 5 to doesn't matter, 100, 1,000, I don't know about a building that has 1,000 doors, but whatever, okay, you can literally, the minimum down payment is 15% down, whether you live in it or not. That's it. That's what I wanted to say. So I find it interesting. The minute you go a little bit higher, now all of a sudden it becomes less expensive as far as down payment goes.
Yeah, and we have seen that with the same down payment, you can go 20% down on a 4-unit or 15% down on a 6-unit. So
exactly.
Sometimes it is worth looking at a little bit of a bigger property with that same down payment.
Yeah, and the thing is that the minute you go, the other part of this equation is when you go over $1 million and you're buying under 5 units, you're capped out at $1 million. So after you pass $1 million, you need to put 20% down. So if you buy something at $1 million exactly, the minimum down payment if you're going to live in that fourplex is $200,000. If you were at $999,999, then at that point the minimum down payment on that one would be $75,000. Right? So it's a big jump for one penny, if you will. But again, you can buy a property at $10 million if it's a multi-unit over 5 doors, and the minimum down payment is 15%.
Excellent.
Okay, so I just wanted to clarify that because
absolutely.
I know that people have questions about that all the time.
And now other investment properties could be more on the commercial side. That's different down payment structures depending on whether it's owner occupied or not. We're looking anywhere between 25 to 35% down payment. But when we say commercial, it could be anything. It could be office spaces. It could be warehousing. It could be commercial condo that you buy and you rent out to a business. And, restaurant space, any kind of commercial space that you find that you know that you can rent out easily to a business. And of course, on the business side, it's completely different rules. There's no régie du logement. It's run completely differently. The interesting one that I find is vacation rentals. You buy a chalet, you rent it out.
Whether short-term or long.
Short or long, exactly. And it doesn't even have to be in the country or in the city. You could buy a vacation rental in Vancouver. And rent it out. You can buy one in the States and rent it out.
I find that the big trend over the last couple of years was for people to actually buy vacation rentals, which they use themselves. Okay, so they buy the vacation rental. They say, look, we're always going up north. We're going to Montreal, we're going here, we're going there. Let's buy this property. We're going to use it, but when we're not using it, we'll rent it. And it's great. And there's nothing wrong with that. And you can get away, because it's considered a secondary property for you, you can get away with putting 5% down.
Because you're using it.
Because you're using it. Exactly. So, yeah, it's...
so that is an unknown fact sometimes, that because it's a lot of people think because it's a second home, you have to put 20% down. But if it is for your own usage, it is 5% down. So that's very interesting. I'm glad you mentioned that.
Yeah. And my favorite, or has become my favorite rate lately, even though I say that you shouldn't invest in condos, for condotels. So condotels is something that we got into last year by happenstance. So we ended up buying a condotel downtown, and after we bought it, there was literally nothing else to do. The building itself, so in other words, the hotel manages the rental of that unit. And then at the end of the month, you get revenues for it, which is pretty cool.
Yeah, and the reason why we ended up with a good price is obviously because of COVID.
Yeah.
Some people were offloading their condo units. So basically a condotel is a condo unit within a hotel. So it's a hotel suite within a hotel that they rent out to regular folks, and you're allowed to use it a certain amount of days per year.
Which we have. Yeah. We've used it a couple of times.
And you get revenue sharing from it. So whatever they collect, you get a certain portion of it. It could be 50%, could be 60%, whatever the hotel deal is with you, and they manage everything from A to Z. You never have to clean it, you never have to repair it, you never have to do anything like that.
And one of the big ones, so for people, again, you see, bam, she just like whacks that microphone. I love it. So one of the other I'm telling you, I've rubbed off on you here. So no longer do I break things in the studio. It's Merav that breaks them. But anyways,
I'm sitting on my hands right now.
Okay, so no, don't. It's okay. You're European. You're free. Flap your hands.
So it's
fly free, my child. So the next one is REITs. Right? So people that want to invest in real estate but don't want to actually own the property. They don't want to deal with anything. They don't want to deal with changing toilets. REITs are the way to go. So REITs are
real estate investment trusts.
I see I was testing you there.
Yeah, I saw that.
Yeah.
You test me
and
live.
You can go in, they're publicly listed. You can buy shares in the REIT. The REIT, there's different REITs that'll invest in different things. There's REITs that'll invest in large commercial properties to small properties. And you go in, you buy shares in it, and now you benefit from the revenues that come in from that REIT, whether it's dividends that you get or income. So it's pretty interesting.
Yeah,
I own some REITs in my portfolio. I think they're good. I mean, I don't want to give financial advice to anyone, but I think for me, I have them in my portfolio. And if you've been wanting to get into real estate, it is a good idea to take a look. Ask your investment advisor about how you can kind of get into that.
Absolutely.
Yeah. And the other thing, joint ventures.
Yeah.
Right. So if you don't have necessarily all the resources, you can go in with a joint venture, a partner, and
you each put in what you've got, whether it's money or talent, and you buy something.
Exactly. Merav, we're out of real estate. If people want to get a hold of us,
you can reach us at the office at 514-680-4674.
And if you haven't done so already, please take a moment to subscribe to our YouTube channel, which is newsonthego.ca. Till next week, everyone, have a blessed week. Love you all.